How's it going? Can you hear me? Yes, I need a strong yes. Yes. Okay, next question. Who is tired right now? Tell me. Raise your hand if you're tired. Raise your hand if you're super tired. Okay, good. Good. Listen, I got a little bit of an exercise then to ease your being tired. I want you to put your right hand in front of you right now, just like that. Just stick it in front, okay? Then do it the same with the left hand, okay? Now put it together. Put it together again, and again, and again. Bravo. Check. Bravo. Okay, that was the actually applause for your making it to the conference and for the conference organizers to putting this whole show together. This is not easy to put all the logistics together. And because of that, now that I'm here, I'm going to bore you for the next 20 minutes to death about a little bit of charting. My name is Adrian Zdunczyk. I am a charter market technician. This is, to the best of my knowledge, the only title in my country, in Poland. And I really hope that there will be more people inspired to go ahead and discover the real technical analysis, not the squiggle lines that you see all over the TV, not the things that you Google and see in the Google gallery for those random people sitting in front of 50 screens because they need it. This is all fake. This is all fugazi. If you've watched Wolf of Wall Street, one of my favorite movies, this is what it is basically. So I want to start off by saying that we know nothing. There's not a single thing that we can really predict with 100% certainty about future. I have no idea if I wake up tomorrow, perhaps I'm dead after this presentation, maybe I slip, maybe I fall. We don't know. And the further into the future we try to predict something, forecast, set certain expectations, the less certain of that can we actually be. So it's better to assume that we are objectively ignorant. And objective ignorance basically tells you that you agree that you cannot know every single thing going on around the world in real time. It's impossible. It's impossible to be ultimately wise and have and possess all the information available in the world just like that. And that leads naturally to uncertainty. And this uncertainty is often what causes us to act irrationally and makes us often disagree with ourselves. So that one time when we look outside the mirror, there is a sunny, shiny weather, and you say, okay, this is going to be a good day. And then the rain comes up, and you say, okay, this day sucks. It's terrible. The weather sucks. Politics suck. Everything sucks. It's bad. And that may differ only 2 hours on the timeline, right? So it's very easy for us to change our opinions that are dynamic, that depend on our mood. This is exactly what causes a lot of noise, this unwanted variability, so that it actually makes doctors prescribe different medications and different pills to you depending on what time of the day you actually pay visit to them. And because of that, because we live in an uncertain world and there is so much noise, we need some simple rules and guidelines, something that we can stick to. Imagine you wake up each and every single day at 7 a.m. or even worse, at 4:30, as my good friend Oscar Martinez. 4:30, I could never wake up this early. I'm sorry. But imagine you wake up and commit to it every day, then you do your washing, maybe make up your hair or something like I do every morning. And that builds a little bit of a routine, something that you can stick around, something that you can follow every single day, and that makes your life simpler because you can arrange something that is unpredictable in a little bit more constructive way. And those simple set of rules, of guidelines, are actually called linear models. Linear, in this case, means simple. So it can be a set of very simple rules that makes your life better and more consistent. And if you think about it, this is exactly what technical analysis is for finance. It is basically a toolkit for managing the risk it gives you access to certain charts and indicators, and that's it. It is not supposed to tell you the Bitcoin target for the 2027. Don't ask me that, okay? It's not going to tell you what the weather is going to be like tomorrow. It's not going to tell you whether you're going to have a 100% guarantee win. None of that exists, okay? There are no holy grails in trading. It's not resistant to market manipulations. It takes one tweet from Elon Musk basically to pump Dogecoin or other shitcoins that are out there. It also is not a crystal ball to predict the future, right? So this is, again, fugazi, this is fake. This is a very stereotypical approach to technical analysis, and it's fake. And we know yet that technical analysis works. It is proven to work mathematically, statistically, financially, and academically as well. And it works because we make it work. We as people, as humankind, we tend to undergo certain psychological mechanisms that are driven by fear and greed when we are uncertain. This is eventually what makes us survive, because imagine you see a bear in a forest, and you see it, and you look into their eyes, its eyes, and you just stand still and not move. Well, if you do not fear, you die. Isn't that right? So it is something that is natural, something that is our primal instinct, something that we cannot deny. It just happens. However, when you learn about that, you can actually learn to control that as well to some extent. And at times it happens that all of our unpredictability, all of our stress, all of our fear and greed are directional. It may cause us to act irrationally. However, this irrational behavior may be directional. It may be biased towards the bullish side or the bearish side. You may prefer the left wing of the political scene or the right wing. Those are biases. We are biased and prejudiced towards the other group. And this is what happens also in finance. And this is exactly the reason of what we call trends, which is the key term in technical analysis. And trends are nothing else than price movements, directional price movements that tend to persist, that do not fail on the next minute, on the next day, that they just keep going. This is exactly what took Bitcoin from $3,000 in 2018 to $69,000. When it broke 20K, everybody thought, okay, this is done. Like, it's not going anywhere else. Then it pulled off $30,000. And, well, everybody at one point, including me, would have expected a little bit of a correction because, well, guess what? Such a big asset is actually pumping like it's crazy, so it needs to correct. Well, this is a catch, right? There is this hook to it, small print, because the markets have no rules. There are no fixed rules. There's nothing that markets should do or should not do. However, what we know is that those trends tend to persist, and this is exactly what takes Bitcoin irrationally high in the bull markets and irrationally low in the bear markets. On top of that, trends are fractals, so it is basically telling you that trends are self-complex. Those fractals are self-complex objects that you can see in real life, in the real world, because the world is not ideal. If I tell you that I'm 1.75 meters tall, I'm probably lying because I'm not 1.75. The chances for that are infinitely low. I'm maybe 1.7500000003. It's very difficult to get close to ideals. In fact, they are not possible. So because of that, we have to take different set rules of measurements. And there is a very interesting thing called coastline paradox that speaks about fractals. Because if you want to measure a borderline of a country or a coast or an island, then the actual distance, the actual size of the coastline is going to depend on what size of the ruler you pick. Because the smaller the ruler you pick, the greater the length, the greater the distance, the greater the size. And trends are fractals as well. They are self-complex. It is impossible to say, okay, Bitcoin is bullish. It is impossible to say Bitcoin is bearish. It is impossible to say at one point that Bitcoin is neutral. It can be all of this at the same time. Because one primary trend may tell you that we're in the bull market. However, secondary tides, the ones that are corrective often, may trend against the bull market trend and may be corrective to the downside. And on a lower time frame, there are fluctuations that are completely irrelevant, that are a source of noise, and may be neutral at all. So it can be all of that at the same time, which is why we have to be precise about what time frame, what time scope we want to apply technical analysis to. And because trends tend to persist, there is this very wise saying that trend is your friend. How many of you have heard this line ever before as traders? Trend is your friend. Okay, good. Because there seems to be that the new trend has started for Bitcoin. And I dare call that a fifth bull market. Not because I say so, not because this is my opinion. I may always be wrong. So it's not about what I want to see, it's about what is actually in the chart. And what I look at in the chart objectively is that the same signal that took us before into the bull market all-time highs and passed beyond that is here with us right now. And this pattern is that after the midterm bear markets, such as 2018, 2022, and the 4-year presidential cycles backwards, they are represented by the primary trend line, the 200-day moving average, that continues to decline persistently. The inclining line, the rising line, tells you about the bull market conditions. So the breakout of the price, when the price of Bitcoin breaks above this declining 200-day market line, trend line, and it breaks so after the bear market, the midterm bear market, into a new pre-election bull market, and it consists of the trend, the move that tends to persist. It doesn't fail, it continues. And it is backed by an actual inversion of the line. You can tell that on the right-hand side, the upper right corner, the line starts curving up a little bit. And this line tells you if it's a bull market, or if it's a bear market. So if the line is declining, this is the market telling us that we're in the bull market. It's not me telling that. This is not my opinion. This is an objective fact. If the line is inclining, and it is, then it is a fact. And it is also confirmed by multiple techniques that we can use in technical analysis, such as technical levels. Those are the fancy support resistance lines that are always obvious only in hindsight. Those support and resistance lines are caused by our biases. By our hindsight bias that makes us think that something in the past was predictable, even though it wasn't. By loss aversion bias, which makes us cut the winners early and hold on to the losers, which is completely opposite when you think about that, to what we should be doing. You should let the winner run and cut the loser short. And because of loss aversion bias, this directional mistake that we make because we hate losing. Losing sucks. We hate losing. Nobody likes losing, in this room at least. Me for sure, not. So those biases make us act irrationally, even though there might be no reason for us to believe that the trend will fail. We see that the previous price action levels, just reverse at a single level or line, 30,000. We tend to often anchor towards those round, beautiful numbers, like 20,000, 30,000, because they are easy to remember. They have no significant meaning per se. It is only in our minds that makes us act and believe it has some meaning to it. It is called magical thinking, when we do not focus on the process, we just focus on the outcome. So we do not think, okay, why the hell would $30,000 matter even? Like, why is it important? So instead, we accept that you buy the support and sell the resistance, or that you buy the rumor, sell the news. Those are heuristics. Those are these learned behaviors that make us act irrationally and bid and sell, buy and sell around those round numbers, and those are technical levels. When we look at the Bitcoin price action that takes us from 15,500 to 31,000, this makes it 100% movement on an asset worth $500 billion. Can it be a coincidence that such a big asset moves 100% in one direction and stays in the same direction or above the critical trend line for the 5 months. If the prices were random and had no memory, it would be basically up and down all the time. And somehow, Bitcoin tends to move 100% for 5 months straight, top to the bottom. Of course, there are some corrections. However, that is a fact. Anything that is on the left-hand side of the chart is a fact. Anything that is on the right-hand side, something that is yet to be written, is our opinion. The confirmation came in also from the volume, breadth, volatility, and like I said, 5 months spent above critical levels that used to be the main resistance, call it like that. It is not a coincidence. It is not an accident. 500 billion asset doesn't move in coincidence for 5 months straight up. That is what makes it clear, an objective, and a fact that the bull market is confirmed. The next factor I want to tell you about is seasonality. And I mentioned midterm bear market and pre-election years. And that has to do with history. Just like with weather, we cannot predict what the weather is going to be. However, somehow you're not wearing a cold, thick jacket during the summer because you know that it's going to be hot, even though you don't know the future. Same with the prices. And it is perfectly mastered in the worksheet book called Stock Traders Almanac by my good friend Jeff Hirsch, who I got to see and meet and confirm how excellent of a person he is in New York at the CMT Symposium, the 50th anniversary. And luck has it that 2023 is a pre-election year, which means it is a year before the US elections. And that 4-year presidential cycles is often what drives the markets. Because if politicians want to get re-elected, they will pump the hell out of the market. Because it makes people more convenient, it makes people more happy, basically happier, more certain that they are the right choice. And this excellent chart is incredible. It tells you a story, aggregated story from 1939 through 2021, and averages out all the pre-election years that we had ever since then. And the green line, if you can tell it, it's the one that sticks to the top on the right-hand side. It's the one that performs the best, with about 20% average return. This is the pre-election year after the midterm bear market. This is exactly what happened in 2019, in 2015, and in 2023. And since the World War II, 1939, the pre-election year had only one loser. 84 years and only once pre-election year was bearish. Only once. Which means that you have 83 to 84 chances, that's 98.8%, that the pre-election year of 2023 is going to be bullish, which means that it closes higher than it opened, which basically confirms and contributes to the bull market. 83 to 84 chances. You have less than 2% of chance of being right of betting the opposite. It's like basically ignoring all the chances. You just want to lose money, right? That's why you bet on, ignore all the 99% of chances and just bet on something that is ridiculously low probable. On top of that, we had January barometer. This is a cool seasonal pattern that basically says that as January goes, so goes the year. And over 72 years, that's 2 or 3 times as long as I live, so it's not random, 72 years of data, with 83.3% accuracy ratio, that if January closes bullish, the year closes bullish as a whole, which means that this is a bull market, or if it closes bearish, that the year is bearish. In 2022, January closed bearish. It closed lower than it opened. In 2023, it closed way higher than it opened. So long story short, being a bear in 2023, this year, is like betting on negative temperatures in the summer. Even though you don't know the future weather, you don't know if we have, here in Poland, maybe 30 degrees in the summer. If for the past 200 years or so, the temperature never went below, imagine, 25 average Celsius, I'm making it up, whatever. then what is the logic behind expecting the opposite? Even though you don't know the future. Same with the prices. Even though we don't know the future of the prices, when we have a bet from the history over 84 years, giving us 99% probability almost for winning, for betting bullish on the year, then why would we take it opposite? So quick point about Isaac Newton. How many of you have learned about Isaac Newton in high school, in schools? Not many hands. Isaac Newton, okay? So Newtonian dynamics basically tell you about something that can be observed when you compare a speeding truck and a speeding car. Imagine they are all moving with 100 kilometers an hour speed velocity, and imagine if they crash into a wall. What happens? Which one is going to cause more damage? Number two? If you think that it's number two, raise your hand. If you believe that more damage is going to come from a speeding truck, raise your hand right now. Yeah, exactly. So this is the same velocity. So what is different? The mass is different. And trends are like those speeding trucks. They are full of momentum. They are full of speed, mass. And it's not the speed or mass alone. It's the product of them both. So if you compare it, it's a little bit like a market capitalization, which is the bigger the market, the bigger the money in the market, and the greater the slope, the faster it moves. It is like the speeding truck. And trying to trade against those trends is like trying to slow down or stop the speeding truck with your body weight. And that's a momentum principle. That basically tells you that you want to be long the winners, long strength, and short the losers. So you find the ones that perform the best, and you set your portfolio outweigh towards it, maybe give a little bit of long position if you want to it, and find the biggest losers and short them, because the trends will continue. And that translates to market behavior that is often full of positive feedback loops. That is exactly what makes us buy because everybody is buying and sell because everybody is selling. And there is the whole psychology of a Bitcoin cycle that basically translates to all the irrational behaviors mapped out. And by tracking those irrational behaviors and how they aggregate, we can track the phase of the market. And this belief cycle part is the one that shows you that the greatest amount of cognitive dissonance is experienced. The cognitive dissonance is a rejection of reality. Something that, like I said, the line is moving, but your mind is telling, okay, I'll short it, because to me the line is moving down, even though it's right up. So the greatest amount of cognitive dissonance is in the early stages of the reversal. So by observing how much cognitive dissonance there is, how much people reject, how many people would reject a reality, and say, that, okay, even I'll ignore all the facts, I'll ignore all the 99% of chances, I'll ignore all the lines moving up, and just do the opposite. This is cognitive dissonance. So putting everything together, I'd love you, everybody, to take away that trend is your friend. It's like the speeding truck that you never should oppose. It's going to run you over, and the road is going to be filled with dead bodies and dead portfolios. UND portfolio is this momentum investing that basically suggests so that you long the winners and short the losers. It's a long strength and short weakness. And those principles drive the market cycles. And by analyzing the market cycles, we may discover that we are now in the disbelief stage, which is very early stage of the bull market. If you add a little bit of patience on top of that, you may finally discover that trading, based on technical analysis, can be profitable. Thank you so much.